I'm Piers Mepstead. I'm the Managing Director of Financial Advice Centre. And this gentleman, hopefully you already know as well from the previous webinars, Adam Smith, who's obviously a director here at the same time. So we're lucky enough today to have two top fund managers with us or representing their investment houses. First of all, we've got Lucy up in the top left-hand corner, Lucy Mitchell, who is the Investment Director for Evelyn Partners. Give you some idea of Evelyn Partners, are a huge organisation in their own right, with control over about 50 million of client funds and around 3,000 employees and analysts, as well as over 300 fund managers there as well. We're also lucky enough to have Tom Leck, who is a client portfolio manager. So the guy who spends his day, all day, every day, looking at the markets and making those changes. He's part of abrdn, and abrdn now are one of the industry's largest investment houses around, with over, I'm told, £500 billion of investment money. So, like I say, we're lucky enough to have you two with us. Thank you very much for joining us. We're hoping to spend about half an hour, 40 minutes, where hopefully we'll find out some of your insights and glean some information that's going to be really useful for us to find out what's been happening in the market, what we can expect, and what the future's got in store. We've been lucky enough, Adam, to have a whole number of questions come through again from our clients, which we're going to be putting to you. And I know time's short, so I'm going to hand you over to Adam, who's going to go through and start those questions. Thank you, Adam.
Thank you, Piers. Yeah, and welcome everyone to sort of first webinar in 2023. Something we've had some really good feedback on the previous two that we carried out last year. So we felt it was really a good time to start 2023 with another webinar with two new guests, as Piers related to. So first question, I'm going to come to you, Lucy, actually, if you don't mind. We've collated a lot of questions that clients have come in, but first one is the FTSE 100 has increased recently. Yeah, a lot of portfolio values are still down over the last 12 months. Yes, this year has started really well, but it's that correlation really, I think, between the FTSE 100 and portfolio valuations, if I may.
Absolutely, Adam. Well, good morning, everybody. Really pleased to be speaking to you today. It's a really important question because I think for a lot of you, you're probably sticking on the news at 10, listening to the BBC presenter, and they are going to be talking a lot when it comes to business about the FTSE 100. So let's just remind ourselves what the FTSE 100 is. It is, of course, an index made up of 100 of the largest companies in the UK. But when we think about how we invest in the UK, and hopefully Tom will agree with me, you know, when we look at your portfolios, we're not just investing in the top 100 UK companies. How do we invest in the UK? Well, you can look at it from investing in the largest companies all the way down to the smallest companies. There's also things like, you know, do we classify a firm as value or growth? I won't get too much into the detail of that, but as fund managers, we have to think about all the different ways we can invest in the UK market for you and what those opportunities are. Now, last year in 2022, you know, we all were aware that it was a very volatile time in markets. And yet, as Adam has alluded to, the FTSE 100 was incredibly stable. In fact, it made money for clients. But it wasn't where we had all our money for our clients in the UK. We had it across large companies and small companies. And unfortunately, the mid-sized companies, the mid-caps, the small companies, the small caps, did not do nearly so well. Within the UK FTSE 100, although that market itself, that index went up, actually, it was only down to a handful of companies really that were producing those returns for you. So unless you had a big weighting in Shell and BP and some of the miners, and maybe some of the pharmaceutical companies, actually, a lot of things bumbled along last year. So you need to be in very few companies to capture all that return. Generally speaking, we are diversifying client portfolios to ensure that we're not too concentrated. We don't want to have that concentration risk in case those companies plummet. So actually, very few managers were just in BP or Shell. And on top of that, when we're managing money for clients, you know, and I'm sure Tom's the same, we're not just looking at the UK anymore. We're looking globally. So your money in the equity market, it's not just in the UK, it's going to be in the US, it's going to be in Europe, it's going to be in Asia and emerging markets. So ultimately, this one index that the BBC is talking about at 10 o'clock in the evening, this FTSE 100, yes, you'll probably have some exposure, but that will not be where all your money is invested. And that's why you might find that your portfolios likely last year were actually showing minus numbers rather than a positive number that the FTSE 100 was showing.
Okay, thank you, Lucy. And Tom, do you have anything to add on that? I mean, I know we talk about the FTSE in the last 12 months, but maybe sort of talk about FTSE in comparison to the other indexes over the last 3 or 4 years, and if we'd have been overweight or 100% in the FTSE 100, how we might have performed compared to those other indexes, as Lucy talked about that sort of diversification.
Yeah, sure. So Lucy did a very good explanation there. And just to highlight just how concentrated the FTSE 100 is the top 10 stocks, which account for around 50% of the FTSE 100. So when we're talking about what the FTSE 100 is doing in the news, we're actually thinking about really just a really small handful of companies. But as you mentioned, in terms of performance, it was really unusual for last year for the UK to be the top performing sector across the globe. If we look at 5 or 10 years, the UK is actually in a pretty poor, well, the UK large cap space has been a pretty poor place to be investing, and it's traditionally been more like the US, with much more of their structural growth stocks that have outperformed. So what we've seen over the past 12 to 18 months has been highly unusual. And for us to have made money for portfolios, you'd have really had to take a concentrated bet.
Right, and that's not something that either of you would focus on in taking a concentrated bet on when you're managing client money, I take it?
No, I mean, as Lucy mentioned, unless you held oil last year, it was quite difficult to generate a positive return. There were 1 or 2 stocks that would have performed well, but it really was a case of oil, which, as we know, prices for oil went through the roof as a result of the invasion of Ukraine, which was an event that, whilst some forecast it, we don't really want to invest clients' money just on the on that potential outcome.
Okay, thanks, Tom. I know you talked about the recent market uplift over the last sort of couple of months, and therefore sort of valuations have sort of seen a bit of an uplift since the start of 2023, which is always positive. Can you sort of cover off maybe what the factors that have sort of led to that increase in valuations, and any sort of beliefs or thoughts on if it will continue or if it won't? What are the sort of headwinds to that recovery? Yeah, sure. So at the start of this year, we've seen markets, not just the UK, but markets around the world rally quite strongly. And admittedly, that's off the back of poor performance last year. So valuations were looking a little bit duller. But there's a few reasons why we've seen this rebound. First of all, the mild winter in Europe, that's helped stave off a European recession. We still think there's most likely going to be a recession in Europe, but gas prices came back to actually pre-invasion levels now, and they were able to store a lot more gas as a result of that mild winter. So we've got a more positive outlook on Europe. We've also got a much more positive outlook on China. We think that China is likely to be the fastest growing economy in 2023, and that's for a variety of reasons. But the Chinese authorities surprised investors by their sudden reopening of the economy. So a lot of the Chinese residents have been locked down, so they've got lots of pent-up savings. They're likely to go and travel more, which is positive news for the global economy in terms of European and US exporters, so luxury goods, for example. And it also spells good news for potentially Latin American countries who are commodity exporters. So yeah, we're very positive on China going forward as well. But I suppose the key thing that was more driving market sentiment in the past couple of months was this expectation that the Fed was done in the US with raising rates. So in November, we had a 75 basis hike. In December, we had a 50 basis point hike. But at the start of this year, it fell to 25. So investors were thinking, well, the next stage is either hold rates or potentially cut them. And that optimism really did feed through to markets. So we personally think that's probably overdone, and we've seen markets come back a little bit in the past week or two. But that, I think, is what has really driven markets over the past couple of months. Great, thanks, Tom. And I'm pleased to see, Lucy, you had nodded along with some of those comments that Tom was making. Have you got any sort of anything else to add to that point?
I agree with Tom entirely, but let's not forget that the market wants to go up. Markets don't want to be falling. People want to be joyous. They want to be thinking positively. And so it doesn't take a lot to actually move the markets because they want to move forward from last year. I think there's just one other thing to mention in relation to interest rates, but obviously is inflation. And ultimately, all of us and you all on the call will be noticing the cost of living. And, especially going to the supermarket and I'm looking at the price of my bottle of wine and I'm not very happy about the price of that, glass of wine that I'm having or that bottle of wine that I'm buying. And we're all noticing it in different ways. And I think ultimately this year, we are beginning to see inflation coming down. Now, in the US, that looks to be moving a little bit faster and a bit swifter than we are here in the UK, but we do import a lot of inflation. So, there are different reasons for why, our inflation might not fall quite so quickly, but we are seeing a trend of inflation falling. Now, you can break inflation up. There's things like food prices, which have been very sticky, that they're not falling as much, but generally things like petrol prices, when you go and fill your car up, that is falling, and that is making us feel better and more confident about how we feel about the year ahead. The problem is that we can't get too ahead of ourselves, so we need to take this nice and slow. Interest rates, we hope, will start peaking. As Tom said, we've seen some increases, we expect a couple more, but we hope they're going to peak pretty soon as inflation continues to fall, and the markets are going to like that. They want interest rates to stop rising. They want, by the end of the year, they want them to start falling, and they want inflation to fall. And that's good for all of us. It's going to be, if interest rates start to fall, you're going to pay less on your mortgage. If inflation starts to fall, it's going to cost you less for your pint down the pub and your glass of wine. And that's good news for all of us, and that's what the markets are looking for, and that's what they've been very excited about at the beginning of this year, as they start believing that inflation is genuinely falling and interest rates are hopefully reaching their peak. We had a wobble in the markets last week, as I think some people felt perhaps we'd rallied a little bit too hard, too fast, but generally I think we're moving in the right direction.
Okay, and that sort of, you feel that we might have reached that sort of peak inflation. Different economies, as you put, at different times will reach different points and will start to recover or start to reduce. But do you think that we have had that sort of peak level of inflation globally?
I do, and I'm very interested to see what Tom thinks on this. But I think we have. However, I do think we need to be very conscious of the different aspects that make up inflation, the different pots that go into it. So we look at things like housing and shelter, we look at food prices, we look at the cost of fuel. The area that's really falling is fuel prices at the moment. And I think everyone will notice that when they go to the pump and they fill up their car, that has genuinely fallen. Food prices and housing, that's quite sticky. It's not moving as fast as we'd like to. Unfortunately, food prices are still going up at the moment, but we do hope we're about to reach that peak, Adam, and we're going to see overall inflation falling back. But until the Bank of England, until the Federal Reserve in the US, which is their big bank that makes the decisions, until they feel confident that genuinely everything is moving back with inflation, we're probably going to see a couple more rate rises to help slow inflation. But I think we're definitely moving in the right direction. I think we probably have hit peak inflation for now.
And Tom, your thoughts?
Yeah, and just to elaborate on that. So when Lucy's talking about sticky inflation, for your clients, it's important to think about if energy and food, which are the volatile headline inflation factors that we think about, when we're talking about sticky inflation, we're talking about things like core services inflation. And what we've seen is in the UK, in the US, we're very services dominated economies. So as we came out of COVID, we were moving more from goods to services. We're spending a lot more on services. And now the services sector is very labor intensive. So a big cost for a lot of services companies is the cost of wages. And that's why we're seeing this really, really structurally tight labour market. And that's important because if everyone's got a job who wants one near enough, and on top of the fact that a lot of people, especially in the US, there's a lot of excess savings. So it's around $1 trillion that American citizens are still sat on. And it's not quite as much in the UK, but there's still savings. There's pent up demand. The services sector is actually still below pre-pandemic levels, So we've still got room to grow in the services sector. And mortgages. Now, a lot of people, and I know I keep referring to the US, but a lot of the data that we get is in the US, and it does drive the global economy. If we look at US mortgages, it's around 90% of US mortgage holders are on fixed rates, and they hold their mortgages for 30 years. So they are very, very immune to what interest rates go up for their biggest cost, their mortgages. It's only when they look to move house that they have to pay the higher rates. And that's why we're seeing things like the housing sector come down a little bit. And it's a bit similar for the UK, but our mortgages are obviously a lot less, less in duration. But the reason why I'm mentioning that is, unless you're being impacted by the cost of raising rates, you're a bit more immune to when the rates go up. And that's why the services is sticky, because it's not likely to go down as much compared to headline inflation.
Right. Okay, great. Thank you, Tom. Appreciate that sort of input. What we did sort of maybe should have highlighted at the start, as we did in the previous two webinars. If you've got any questions, please type away in the sort of question box at the bottom. And we've had one come in actually that I'm just going to put to you, Tom, first. Do you think the recent Brexit announcement will help optimism and help markets move move positively?
Yeah, it's a little bit early to tell because there's, as always, the devil is in the detail. But I think from a UK economy perspective, the thing that's really dragged down growth for the past few years is the fact that we've got low productivity. We've also got worker shortages, and it's been quite difficult to bring in the staff to bring labour workforce up to meet demand. And we've also got lots of issues with sterling. So a weaker sterling just makes the cost of imports more expensive. So anything to try to bring more clarity on the Brexit picture will be welcome news. But I think it's a little bit too early to tell from this stage. But the important thing to go back to Lucy's point at the beginning of this call, we typically look to, as you do, look to invest globally. So what's going on in the UK isn't necessarily going to dictate performance for our clients.
Just on that note, Tom, the sort of classic fund manager answer there, I think, sitting on the fence. I think also probably just to add to that is that the news that we've had about Brexit, I agree it's too early to tell, but I think also what our clients are looking for, or probably that reassurance, is that it's not bad news. So the market
absolutely
negatively from it. So from that point of view, it's fairly neutral. So we'll take it as being relatively positive, really. But also just picking up on what you were saying there about the UK slow growth. I mean, just harping back, I think, to that first question when we were talking about the FTSE. I mean, it's only just recently pushed back the heights that it was some 5 years ago when it was in the high sevens. So I just wanted to not let that comment go, because again, many of our clients are seeing this FTSE index or top 100 increase a lot, but it is only just recently got back to the heights it was 5 years ago. So thank you for the answer. Yeah. Adam, over to you.
And Lucy, any of your sort of comments on the Brexit decision recently, or the effects from managing the funds from your point of view?
Yeah, I mean, I would have to agree with Tom. I think it's the devil's in the detail, and we need to be looking at that and studying it. But what I can say in relation to Piers's point is that, ultimately, stability is what the market is looking for. And if this agreement brings greater stability and greater knowledge to the market about how we're going to be working things moving forward, that will be positive. So ultimately, the more information we have, the more stability we can create around these things. The market likes that. It doesn't like unknowns. So we want to have as much information on the table as possible. And once the market knows, it will digest and it will react accordingly. But at the moment, the news out from that we've seen this morning is very positive on it. So, hopefully that is good for markets.
Great. So in terms of other events that happened last year, sort of as we did this webinar very briefly after sort of Liz Truss's original budget. I mean, can you sort of cover what's happening in the bond market, especially like at the moment, especially after last year's fall in value after the budget that happened in sort of September time? Lucy, do you want to sort of talk us through that bond market?
Absolutely. Well, For everybody on the call, let me tell you that I haven't talked about the bond market in probably a decade. For 10 years, it's not been something we've been particularly interested in. We haven't seen very much value. I'm not going to go as far to say as I'm excited about the bond market, but I'm on the brink of feeling something. And that, trust me when I tell you, that is quite exciting for us, because for a long time, the returns you were getting in bonds was so low. Now, let's just remind ourselves what the bond market is. It's IOUs, okay? It's lending money to the government in the form of, let's say, government gilts, UK gilts. It's lending money to big corporations and companies like Nestle or BP or Shell and buying those bonds. And there is a greater safety aspect to a bond than there is in equity. If a company was to fold, then actually the bondholder would receive some, not all perhaps, but they would perhaps receive more than the equity holder would. So it's seen as a safer way to invest your money. And I use that word, safer way to invest your money, less volatile way to invest your money, usually. Usually, it should be, historically, when we look back, less volatile to invest in bonds and equities. That was not the case last year. And we saw a very rare occurrence. When you look back in history, you won't see this very often, where the bond market and the equity market fell together. What you would usually expect is the equity markets to fall and the bond markets to be far more stable. That was not the case. Both fell. And when we think about investing in areas that are less volatile and that are safer places to place your hard-earned money, we think about a UK gilt, so lending to the UK government, and we expect to see very little movement really generally in the bond price. Some of our clients, were holding bonds that they'd held for a long time in their portfolios, and they were down over 30%. A UK gilt, lending money to the government down over 30%, really unheard of. In lots of our careers and generations, it's not really what you would expect at all. And so it's very hard for those clients who are saying, well, hang on, I haven't taken very much risk. I'm a client that doesn't want to take a lot of risk. I don't want a lot of volatility in my portfolio. And yet these bonds are down massively. So last year was a very strange year for the bond market. But as you'll all know, unfortunately, when something like that occurs in a very market stressed environment, fortune favors the brave. And it creates opportunity. And we have seen opportunity in the bond market, which we haven't seen for many, many years. And so that's why I tell you that we're sort of on the brink of feeling a little bit more excited, because we're buying bonds much cheaper for clients that we can hold to maturity, where the government will pay us our money back, or Nestle or BP will pay us our money back. And we can actually make money there for the first time in quite a long time. So it's quite a difficult concept to get your head around the bond market and what's happened in the last 12 months. But let me tell you, as active managers, both Tom and myself and the teams that we work in, that's an area we haven't seen opportunity in for a long time. We've held very little in that area. We've avoided it wherever we can. And today we're telling you there are some opportunities there to go back into what should be a much more sort of stable asset class, we hope, moving forwards.
And thank you, Lucy. Thanks for the sort of detailed response. So I suppose that sort of comes up. I can put the point to you as well, Tom, but add a little comment, is that's where sort of active managers like yourselves can sort of change the sort of asset allocation or make more of a choice towards going back into bonds relatively quickly to see those opportunities. Is that true, Tom?
Yeah, absolutely. So with bonds now, so I very much agree with what Lucy's just said. And the opportunity for active managers is the fact that because interest rates at different maturities, so if we think about 2 years out, 5 years out, 10 years out, the longer you lend money out, the more volatile it is. But given what we're seeing with central banks and interest rates, active managers are able to select the best maturities of bonds to try to get the best risk-adjusted rewards and pick up the best yields for clients. And what I'd say is a lot of clients ask us, well, if I put my money in a savings account, I can get 3.5% to 4% interest rates. But the thing is, going forward now, we can pick up UK government bonds at 10-year maturities that have yields of just under 4%. And the advantage of that, the attractiveness of that, is not only are you getting extremely safe income because it's backed by the UK government, but also there's the scope for the capital gains now as well. So if we do see interest rates start to fall, which we do expect throughout the year, the value of bonds themselves as an investment should go up. So you should be collecting the coupon, the interest payment, in addition to the opportunity to benefit from capital gains.
So the sort of benefit of, like, with sort of picking on your point there, Tom, about higher interest rates and savings rates, etc. Because again, that's one benefit of what happened last year, is that we saw interest rates rapidly increase and therefore savings rates rapidly increase, and we can see those on the sort of bank deposit rates or cash ISAs that are looking at that sort of 3-4%. Is it your sort of thoughts that actually interest rates will start to come down towards the end of the year, and therefore those sort of savings rates will start to return to the levels that we've seen probably over the last sort of 10 years?
Yeah, sure. So here in the UK, for example, we're at 4% banking interest rates. We think that will probably get to about 4.5% over the next couple of quarters. And then we think that the central bank, the Bank of England, will most likely hold off on those rates for a little while before they start to cut again. So we think we're probably towards the peak of where interest rates will reach, as Lucy alluded to. I think the key is how long they hold it off for before they cut rates, and that will depend on lots of things. One, for example, energy prices, which we're seeing come back. Two, what sterling does, because if sterling appreciates, that's typically good news for our inflation. And three, whether they can boost the workforce. So you're often seeing Jeremy Hunt, the Chancellor, he wants to bring a lot of the over 50s back out of retirement, because if we've got a smaller workforce, it just means that employers have to pay more to try to get people back into their employment. So there's a lot of factors at play, but to answer your question, we do think that interest rates are pretty close to peaking now.
And I suppose on that point of like wage inflation, I mean, what effect do you think the current high wage increase demands will have on inflation themselves?
So there's this talk of a wage price spiral, and inflation at the moment is actually higher than wage growth. So we are seeing real pay actually negative. So if inflation's running at 10.1% here in the UK, wage growth is somewhere circa 6%. So net, they're actually still below inflation. But the key is the central banks want to learn the lessons of the 70s and the 80s. They won't let inflation go out of control. They would much rather cause a recession, because they can use monetary policy, so interest rates, to bring it back into growth. It's trying to stem demand that's the issue.
So the focus, I suppose, on that is to control inflation. That's their sort of main focus on what they're trying to do. Is they'd rather go into a recession than lose control of inflation. Is that right?
Oh yeah, absolutely. It sounds counterintuitive, because a recession in the headlines sounds like a catastrophe, and that policymakers would want to try and avoid it at all costs. But it's our view here at Aberdeen, at least, that we think that central banks will most likely, if they have to, they will cause a recession on purpose, because that's the only way they can really get inflation under control. The worst thing for a central bank is inflation that goes too high and they can't do anything about it. They would much rather nip it in the bud as soon as possible. And the reason why it's proving difficult is because there's lots of global factors at play at the moment. And as Lucy mentioned, last year was a really, really unusual year for investors.
Okay, and we've had a couple of questions come in as well. I've answered, sort of asked them as we've gone along, but a couple of us, Lucy, if I can ask one to you as well. So how do you think the next budget from this current government will impact on investment portfolios, or impact on the growth of the UK economy?
Yeah, it's a really good question. I mean, okay, so what are we expecting from the budget? Well, the messages are a little bit mixed. At one point, a few days ago, we were looking at the tax take, and the Chancellor had billions more than they were expecting at this point, which was very positive. And now we're being told that because of the recession, there'll be less tax take over the next 12 months. So they'll need that in the coffers for the future. I think people are quite worried about corporation tax, and we've been seeing some of the fallout from that, and companies talking about, if the corporation tax moves from 20 to 25%, actually, do you know what? We might invest less in the UK, and we've seen people going over to Ireland and talking about deals over there. Ultimately, it will be very interesting to see what they do in a couple of weeks' time. I still don't feel like I've got I'm not sure how exciting it's going to be, and therefore I don't see at the moment how it's going to move the markets. I just don't know. I think ultimately, and please don't judge me for saying this, but I think Liz Truss had a point. I think actually, she didn't deliver it as well as she could have done, and I think it was too hard, too fast. But ultimately, we need taxes to go down in this country, I think, to help give a boost. I'm not sure we're going to see that. I'd love us to, but I'm not sure whether we're going to see that, but that would be very helpful. So how do I think it's going to affect markets? I think if there's no big surprises, then, I don't anticipate the markets, negatively reacting to it. But do I see a big boost from it in the short term? I'm not sure that I do, I'm afraid. I hope that actually later on in the year, in October, we might get some better news. But ultimately, I think there's a lot for them to consider and there's a lot for them to do. But I don't see any of those big decisions being made in the next couple of weeks, I'm afraid.
Okay. Thank you, Lucy. And Tom, if I ask you another question that's come in. So if we sort of consider the impact of the Russia-Ukraine situation and the apparent position of China within that situation, have your portfolio's sort of consideration sort of looked at the attitude of China's attitude towards Taiwan? Is that something that you take into account now that China's starting to open?
In terms of a potential attack on Taiwan?
Yeah. I mean, I know it's sort of fair that maybe the approach has been softening since the Russia-Ukraine conflict. So.
Yeah, sure. And a key factor to that from an investment perspective is the fact that Taiwan really does dominate the semiconductor industry. So throughout COVID, we saw lots and lots of consumer goods. They took a long time to be delivered because basically a semiconductor is in everything from a fridge to an iPad to a car. And with a lack of supply of semiconductors, it does cause issues globally. And that's for that reason, we're seeing the likes of TSMC, Taiwan Semiconductor Company, they're now looking to build plants in the US and in Europe to try and diversify that exposure. So from that perspective, we are seeing companies take steps to try and avert a crisis should China invade Taiwan. But yeah, it's difficult to second guess Xi Jinping and the Chinese Communist Party at the best of times. So, but it is certainly something like that we consider going forward.
And Lucy, you sort of agree with Tom's comments?
I do. I mean, unfortunately, I think the Taiwan situation is rumbling on in the background and has done for years. Let's not kid ourselves. This is nothing new. It's been bubbling under the surface for a very, very long time. But what I can say is, sorry to sound a bit mercenary here, but we have to look at where the opportunities lie in these situations, in these geopolitical situations. And ultimately, again, it'd be interesting to see whether Tom feels the same. But we've been holding some gold in our portfolios for clients for some time now. As interest rates rise, you'd actually expect the gold price to suffer somewhat because there's no income paid on gold. So you're holding it as a store of value. And as inflation rises and interest rates are rising, actually the gold price should fall. However, it's been incredibly stable, far more resilient than you would expect it to be at this time. And we were really looking into why and should we continue to hold it in client portfolios as a diversifier. And actually what we've seen is that China and some other countries who may have some beef with the US are buying more and more gold. And they're buying it because ultimately, what have they done in the past with their money? Well, they've bought US treasuries, which is US bonds, US government bonds. And they're thinking, hang on a minute, look what the US has done to Russia, all the sanctions they've put in and they've frozen their assets. Actually, do we want to keep buying US bonds or should we buy gold? And there's been a massive, massive increase in the amount of gold that's been bought by these countries to have a different store of value. And we've benefited for that with our clients in the portfolio. And that's the sort of stuff we're looking at. There could be this conflict. We've seen it with Russia and Ukraine. The data told us categorically it would be a disaster for both their economies. It would be disastrous for the world economy. It would be disastrous for fuel prices and food prices. The data told us there's no way these guys are going to do it. Why would Putin do it? It's crazy. But he is crazy and he did do it. And ultimately, we do have to think about, well, how do we protect portfolios from that? And what opportunities, which I know sounds awful and forgive me, but what opportunities come out of that? And the China and Taiwan situation is no different. What is going on there? What could happen? What might happen? ultimately, how do we look at our portfolios and put some defensive measures in place? And one of those for us has been gold.
I think that's a sort of really great point, Lucy, about the sort of active decisions that you can make as fund managers when we sort of look to add clients into the portfolios, where you can make a decision as a fund house about going gold and explain that away and not be sort of stuck with a sort of static portfolio. So sort of got one more sort of question to cover that's come in. Tom, if I can place it to you before we sort of wind it up, is say you talked about energy is coming back down. However, as the government will stop the £400 support energy in effect in April, do you think it will then start to go back up? And what effect this will have on energy prices or inflation?
So the energy price is very much dominated by factors beyond the UK. So it's very much globally focused, and there's a chance that energy prices may start to rise again as we see China reopen. So they're going to have more of a demand for commodities and oil, and it's going to be a big swing on energy prices. But what we're also seeing is the UK is extremely innovative in terms of renewable energy as well. So around 40% of our electricity is generated by renewable, and we're a world leader there. So going forward, we're probably going to see this a less of a reliance on fossil fuels. But in the short term, we do expect that the government will probably step in and try to have support for consumers. They are under pressure given the state of the fiscal balance. But yeah, to answer the question, we think that there probably will be more support going forward to reassure your clients.
So Tom, thank you for covering off those questions, and thanks for all that have typed questions and asked questions as we've gone along. Really, I think hopefully those ones that we've had a chance to sort of answer have been covered off. I think Lucy and Tom have done a sort of fantastic job of covering off those questions. Really, sort of asked the sort of hand to Piers to sort of sum up, so we can sort of give people back the rest of their day. So, Piers.
Thank you, Adam. First of all, just a big thanks to both of you for joining us today. It's been really useful, really insightful. It's great to see a webinar where markets are moving forward now and have been for several months, and a lot more positive news on the market. So thank you for your insights, and thank you for sharing that with me. A couple of bits that really sort of jumped out. I think, Lucy, I'm going to pinch one of your phrases there straight away. Markets want to move forward, and thank you for that. Yeah, inflation has been falling, and interest rates hopefully are going to follow soon. That's really what stimulated, I think, what's happened with us that we've seen is that our portfolios, our client portfolios, have started to increase in value from about mid-October. You're talking about a great start to the year as well, but it was also a great finish to 2022. I know we're focused on this year. So nothing really horrendous on the horizon, you're telling us there. Meaning hopefully markets are going to continue to move forward, and we're going to see increases in portfolio values. It's been great today. A couple of phrases that I never thought I'd heard, and another one would be bonds becoming exciting. So again, thanks for that one. Bonds, of course, if you're listening on there, are an integral part of all managed portfolios, a good diversified portfolio. So we all have bonds or a degree of different types of bonds in our portfolio as well. So it's going to be an area that's exciting to hear that's going to be now adding value rather than just giving this protectional side on it as well on that side. So really just to sum up, thanks again for a positive seminar, and and any other questions really from our clients that are listening, please email us in, and a copy of this is going to be sent out as well, so you can watch again in your own time. Thank you again, guys.
Yeah, Lucy, Tom, thank you so much. Thanks for coming on today. Really appreciate your time, and I'm sure clients do as well.
Thanks for having us.
Thanks for having us.
Thanks, Beth. Thank you all.
Take care. Bye.